Most traders look at a chart and see random price movements. They're placing trades based on hope, not strategy. But what if I told you that every single move the market makes follows a predictable pattern? Today, I'm going to reveal 6 core concepts that separate profitable traders from those who blow their accounts. These aren't fancy indicators or complex algorithms. This is pure price action. The same concepts that institutional traders use to move billions of dollars every single day. Let's get straight to it. Market structure. The first concept we need to master is market structure itself. The market isn't random at all. Every movement you see on your screen can be broken down into just 2 fundamental behaviors. Understanding these behaviors is like having a roadmap to where price wants to go next. The first behavior is trending. This includes both uptrends, where price makes higher highs and higher lows, and downtrends, where we see lower highs and lower lows consistently forming. The second behavior is consolidation, those choppy sideways movements where price seems stuck in a range. Here's what most traders don't realize. These phases work together like a continuous cycle. Price moves from downtrends to uptrends to consolidations and back again, constantly accumulating liquidity and institutional orders along the way. Price needs to consolidate between major trending moves. It's during these consolidation phases that smart money positions themselves for the next big move. When you open your trading platform, the very first question you should ask yourself isn't, where should I buy or where should I sell? The question is the market currently trending up, trending down, or consolidating? Get this wrong and you'll find yourself fighting against institutional flow. Get this right and you'll start trading with the smart money instead of against them. Now let me show you what an ideal uptrend looks like on your charts. In a perfect bullish scenario, you'll see price consistently forming higher highs and higher lows. Each time price breaks a previous high, it's telling you that buying pressure is still dominant. The uptrend continues as long as price holds above the major lows. An uptrend ends the moment price breaks one of those major lows to the downside. This isn't just a small retracement we're talking about. This is a complete structural break that signals the entire character of the market has shifted. Every time price breaks a major high to the upside, something incredible happens. You get what we call a break of structure, and this creates a demand zone associated with that BOS wave. Learning to identify these valid major highs and lows becomes absolutely crucial because it enables you to detect signals for trend reversals or continuations before they happen. Here's the reality that most textbooks won't tell you. It's extremely rare to find an uptrend in the real market that mirrors those perfect textbook examples. Price doesn't behave with that kind of mathematical precision. Real market movements are much more complex and dynamic. This brings us to what I call the realistic market structure. This is what you'll actually see on your charts day after day. Let me walk you through exactly how to navigate these more complex scenarios like a professional trader. Picture this. Price has been moving higher and suddenly breaks the previous highs to the upside. Now comes the million-dollar question. How do you identify which highs and lows are actually major structures versus just internal noise? Look at the left side of your structure. You'll notice price experienced an upward movement until it started to retrace. The highest point that price reached before that retracement movement began, that's your major high. The lowest point of the bullish wave that initiated the entire upward movement leading to the break of structure and new high, that becomes your major low. These 2 points create what we call the major external structures. Everything that forms between these 2 levels is considered internal structure, and here's why this distinction is so important for your trading success. If price breaks that major high to the upside, creating a break of structure, you're seeing a continuation signal. The trend is still your friend. However, if price falls below that major low, you need to start thinking about trend reversal. The specific internal price action that happens between those external structures doesn't matter nearly as much as whether price holds above that recent major low. After identifying those recent major external structures, you now have your current area of interest defined. This becomes your trading range. Watch what happens when price enters the retracement phase. During this retracement, price generates a series of internal structures, particularly bearish ones. Then something powerful occurs. After forming a bullish internal realignment, price breaks that recent major high to the upside, establishing fresh major high and low levels. Here's where it gets interesting for your trade entries. The newly generated major low becomes this internal low situated at the extreme. This low is considered major because it's the last low created before price initiated that upward movement leading to the break of structure. Why focus on this low as the major rather than this other one? This is because the low located at the extreme is the ultimate and lowest point before price initiates its upward movement, creating the break of structure. BOS. The second concept is the break of structure. Understanding BOS patterns will dramatically improve your trade timing and selection. There are specific rules that you absolutely must follow to identify a valid break of structure. Miss these rules and you'll find yourself entering trades just as smart money is preparing to move against you. A valid break of structure occurs when price breaks and closes above the most recent higher high with the body of a candle, not just the wick. This is crucial. We need that candle body to close beyond the previous high. This remains valid even if price immediately moves downward after breaking the structure. When this happens, price generates new major low and major high levels, establishing a completely new trading range. If price subsequently breaks this newly generated major low to the downside, it's signaling a potential trend reversal. This shift tells you that price is no longer bullish. We call this a change of character. But here's where many traders get trapped. If price breaks the recent higher high with a long shadow or wick, but the candle body immediately closes below the range of that high, and the subsequent candle's wick doesn't surpass the first candle's wick, we do not consider this a break of structure. In this scenario, we treat this low as an internal structure formed inside our trading range. To identify a legitimate trend reversal signal, you need to wait for price to break that major low located at the extreme, not the upper internal high. Let me show you another scenario that creates fantastic trading opportunities. If price breaks the recent higher high with a wick, and the first candle's body closes below the high range, but then the subsequent candle's wick exceeds that first candle's wick, now we can consider this a valid bullish break of structure. When this occurs, you have a newly formed major high and major low defining your updated trading range. The internal price action within this range doesn't dictate your trading decisions. As long as price remains above your newly generated major low, you're still in a bullish market environment. The only time you should consider a valid trend reversal signal is when price breaks that newly formed low to the downside. This creates what we call a valid change of character pattern, and this is the third concept every professional trader must understand. Chalk. The change of character is where most retail traders lose their money because they don't understand the difference between valid and invalid signals. Let me show you exactly how to identify legitimate change of character patterns like institutional traders do. To identify a valid change of character, as usual, you first need to determine the general market direction. Are we in an uptrend or downtrend? Once you've established this, you must highlight the valid break of structure points. In a bullish scenario, imagine price creating a series of valid breakup structures. The low and high from your first valid bullish BOS represent your major structures. Remember, any price action forming between these two structures is considered internal movement. Change of character patterns come in two distinct types, minor and major. Every time price breaks any internal low, it creates a minor change of character. Here's what you need to understand. A minor change of character alone cannot be considered a sign of market structure shift. This is where countless beginner traders lose their money. They see a minor change of character and immediately think the bullish phase has ended. They believe it's the perfect time to go short. These traders typically place their stop loss just above the internal high, expecting price to continue downward. But here's what actually happens. Price makes a brief retracement and then continues its bullish movement, completely destroying the stop losses of those short traders. They don't understand why their analysis failed, and unfortunately, they repeat this mistake over and over. What these traders missed is absolutely critical. Price never broke the major low to confirm a market structure shift. They shouldn't have entered a short position until price broke that last major low to the downside. Their identified change of character was invalid. Price was simply in its retracement phase before continuing in its primary direction. To get a valid market structure shift signal, you need patience. Wait for price to establish a major change of character by breaking and closing below that last major low that initiated the upward movement leading to the bullish break of structure. Here's the rule that will save you thousands of dollars in losses. In a bullish scenario, a change of character pattern is only valid when price breaks and closes below the last major low with the body of a candle, not just a wick penetration. If price breaks the most recent structure with a long wick or shadow, but closes within the highs range, then the change of character is invalid. You cannot consider this a market structure shift. Wait for proper confirmation before making your move. The same concept applies perfectly to bearish scenarios. For a valid change of character that provides high probability trading opportunities, you need price to break and close above the recent major high with the body of a candle. A simple penetration with a shadow or wick doesn't qualify as valid confirmation. Fair value gap. The fourth concept that will revolutionize your entries is fair value gaps. These powerful formations occur when price moves so aggressively in one direction that it creates an imbalance in the market structure. You can identify a fair value gap by looking for 3 consecutive candles where something specific happens. In a bullish move, the first candle's high doesn't overlap with the third candle's low. In a bearish move, the first candle's low doesn't overlap with the third candle's high. This gap represents an area where price moved too quickly, leaving behind an inefficiency that the market will likely revisit. But not all fair value gaps are worth your attention. There are 6 key factors that make a fair value gap valid and high probability for your trading success. First, the fair value gap must be unmitigated. This means price hasn't tested this zone since it was created. If price has already returned to fill the gap, it's no longer valid for entry purposes. You're looking for fresh, untested imbalances. Second, when price finally returns to the fair value gap, watch the reaction carefully. You want that reaction candle to either close inside the gap or close in the direction of your expected move. If price breaks through the gap with a strong body close, consider the FVG invalidated. Third, look for confluences. When your FVG coincides with support and resistance levels, trend lines, or other significant structures, this dramatically increases the probability of the gap holding and providing a successful trade entry. Fourth, prioritize your FVG selection based on market direction. In bullish scenarios, focus on lower FVGs. In bearish scenarios, prioritize higher FVGs. These typically offer much higher probability of holding when price returns to test them. Fifth, use the Fibonacci retracement tool to identify your highest priority gaps. Mark from the low to the high of the impulsive move. Focus only on FVGs in the lower portion for long entries and upper portion for short entries. Sixth, ensure there's a break of structure before the FVG formation. This confirms you're trading in the direction of institutional movement rather than fighting against the overall trend. Order blocks. The fifth concept that gives you institutional level insight is order blocks. These zones represent areas where significant institutional decisions were made, and understanding them gives you incredible insight into where smart money position themselves. We consider the last candle that created the inefficiency as the order block zone. This is where we believe the critical decisions were made during that specific candle formation. Sometimes order blocks appear at the start of impulsive moves, and sometimes they form in the middle of movements as candles with the same or opposite color to the overall direction. There are 3 major rules for identifying valid order blocks that will actually work in your favor. First, the block must create inefficiency. Inefficiency occurs when you see drastic price movements that create gaps between the candlestick shadows. You want to distinguish between efficient moves where price flows smoothly and inefficient moves that create these gaps. Second, the order block must lead to either a break of structure or change of character. These structural changes are the first clue that the market is revealing its intentions, whether it plans to continue in the same direction or completely reverse course. Third, the order block must remain unmitigated. Order blocks are one-time use opportunities, so you only look for trading setups when price tests an order block for the first time. Once an order block has been tested and failed, it loses its institutional significance. But here's where most traders struggle with order blocks. When you're looking at your charts, you'll often see multiple valid order blocks at different levels. How do you choose which one to trade? You might see a higher order block that looks appealing, but it could turn out to be too weak and price breaks right through it. Or you might focus on the lowest order block thinking it must be the strongest because it's the furthest from current price. But then price doesn't come all the way down to test it, causing you to miss profitable trades. This is where the inducement strategy comes into play. When a chart is moving in a clear direction, let's say bullish, it creates higher highs and higher lows. During this movement, you'll typically see multiple potential zones to enter long positions. Among these zones, you'll have inducement zones and true zones. An inducement zone is exactly what it sounds like, a trap. It's an area that looks appealing to retail traders, but in reality, represents a weak zone that won't hold when tested. The key to identifying inducement zones comes down to two critical factors: liquidity and imbalance. An imbalance is a price region that hasn't been tested. Here, we see an imbalance below the lower zone. Price naturally wants to return and test these gaps because of liquidity. In fact, there are going to be stop losses from buyers wanting long positions, sell stops from breakout traders, and substantial institutional orders at the true zone below. We know this is institutional because major moves originate from these areas. Let me show you a real example. Here's a straightforward uptrend with higher highs and higher lows. During this move, three potential buying zones developed. If you were analyzing this chart right now, which zone would you choose? 1, 2, or 3? I immediately eliminate zone 1 because there's an untested area below it. Price will break through zone 1 to reach that gap, making it our trap zone. That leaves zones 2 and 3. You might think it's zone 3. It's the lowest, so probably strongest, and there's an untested area below that price wants to fill. But you'd be wrong about zone 3. Here's what most traders miss. Price formed a low here, then a higher high. After pulling back to create a higher low, price attempted to break the previous high, but barely managed a small wick penetration. This means zone 3 didn't provide enough buying power for a convincing break. However, zone 2 actually generated the institutional pressure needed to break through resistance convincingly. The lower zone isn't as powerful as it appears. The middle zone represents true institutional accumulation. Now we eliminate zone 3 and focus on the reliable zone. We want price to break the trap zone, adding significant liquidity to the market. After breaking the trap zone, we wait for price to reach our true zone. Switch to a lower time frame, from 1 hour down to 15 minutes for entry confirmation. Wait for a break of structure showing shift from bearish to bullish momentum. There's our signal. Next, wait for price to move toward an imbalance. Here's that region. This is where we enter. Return to higher time frame, set stop loss below the recent low, profit target at previous high. Let the trade develop. Just like that, a winning trade. The sixth and final concept that completes your professional toolkit is understanding liquidity and inducement. Every single market movement follows the same 4-phase cycle over and over again. The accumulation phase occurs when price moves sideways at the bottom, while smart money quietly accumulates positions. The markup phase begins when price exits the range and starts making higher highs and higher lows. This is the trending phase where the easiest money is made. The distribution phase happens when price moves sideways at the top while smart money sells into strength. Finally, the markdown phase occurs when price breaks down and starts creating lower highs and lower lows, beginning the downtrend before the entire cycle repeats. Right before major moves begin, smart money creates traps through liquidity sweeps. Before the accumulation phase ends, you'll see a spring occur. This is a fake break below support, a liquidity grab designed to shake out sellers before the uptrend begins. Before the distribution phase ends, an upthrust occurs, a fake break above resistance that sweeps the highs and traps late buyers. But what is the liquidity? Liquidity represents accumulated capital or substantial pending orders that require execution. Markets must collect this liquidity to generate directional momentum. To survive as a profitable trader and avoid devastating losses, you must accurately identify liquidity accumulation zones on your charts. You can locate liquidity below equal lows and swing lows, above equal highs and swing highs, below or above dynamic trend lines or channels, and below or above order blocks. Now let's examine inducement, the mechanism institutions use to extract money from retail accounts. Inducement occurs at specific price levels, where traders believe conditions are perfect for entering trades based on their analysis and trading systems. Central banks and large institutions exploit these predictable behavioral patterns to lure retail traders into losing positions. Where do these inducement scenarios typically develop? Most commonly at order blocks, support and resistance levels, swing highs and swing lows, and trend lines. Let's start with order block inducement. As I explained earlier when we covered order blocks, these represent crucial supply and demand zones where price potentially reverses direction upon contact. These blocks contain numerous buy and sell orders, making them natural inducement points where traders get drawn into the market. Here's a perfect example. Price breaks recent market structure upward and creates this bullish order block. Traders immediately start looking for long positions by placing buy orders in this area because it appears to be a high probability reversal zone. But notice what actually happens. Price completely ignores this bullish order block. The zone proves invalid and fails all the traders who trusted it. This becomes a classic inducement scenario. We see another order block positioned lower on the chart. Again, price shows no respect for this level, making it invalid and another inducement trap that catches unsuspecting traders. As I mentioned when discussing the power zone selection method, the key is learning to distinguish between valid order blocks that institutions will defend versus inducement blocks designed to trap retail money. Support and resistance levels create another frequent inducement scenario. All traders view these levels as points where price should reverse direction and respect these boundaries whenever price returns to test them. This predictable thinking makes traders easy targets for inducement. Here's a major support zone where price has been rejected multiple times previously. Traders get induced into the market every time price approaches this area, hoping for another upward bounce. They place their buy orders at this support level and wait for the expected reversal. But watch what actually happens. Before moving higher, price drives down with a long wick, hitting the stop losses of all the buyers positioned at the support level. Only after collecting this retail liquidity does price rapidly surge upward. This represents pure inducement, a scenario specifically designed by market makers to extract money from predictable retail positioning. Swing highs and lows frequently behave as inducement points as well. These represent the extreme price levels recently reached, especially on higher time frames like the daily chart, where they carry more significance and price shows greater tendency to respect them. Retail traders consistently get induced into positions at these swing points. For example, on this daily time frame chart, we have this swing high representing the highest recent price level, and this swing low marking the lowest recent point. Most retail participants place buy and sell orders at these swing levels, expecting price to respect these areas and reverse direction when contacted. They believe these obvious levels provide reliable entry opportunities. Instead, price creates false breakouts at these areas, triggering the stop losses of both buyers and sellers before moving in the intended direction. We classify these as inducement scenarios because they systematically trap retail positioning. Trend lines represent the fourth major inducement mechanism. Trend lines connect swing highs or swing lows to display prevailing price direction. They provide visual representation of dynamic support and resistance across any time frame. Most retail traders view trend lines as potential entry points and get induced into positions when price approaches or breaks current trendline levels. Here we have a trend line that price has respected twice previously. Retail traders get induced and take short positions when price respects the trend line on the third contact, expecting continued downward pressure. Alternatively, if price breaks through the trend line, they look for long positions, believing the breakout signals upward continuation. Now that you understand these 6 core concepts, let me show you how to combine them into a professional trading strategy. This approach uses multi-timeframe analysis to maximize your probability of success. You can mark these concepts manually on your charts, or I recommend using the Price Action Toolkit by Flux Charts. This powerful indicator automatically identifies all the smart money concepts we just discussed, saving you time and ensuring you never miss important setups. From the Indicators tab, type Price Action Toolkit and click on the indicator provided by Flux Charts. When you open the Settings tab, you will see many options to apply to the chart, but for now, let's mark the BOS, Chalk, and Chalk Plus in the Market Structure section to get these automatically identified. Next, we have the Fair Value Gap section. If you enable this option in the indicator settings, they will appear automatically on the chart without any manual work required. In the Settings tab, increasing the sensitivity removes smaller gaps and only shows the larger, more significant ones that are worth your attention. Finally, we have the Liquidity Grabs feature. When you apply it to the chart, you'll notice red and green circles appearing at key levels. These represent bearish and bullish liquidity grabs respectively. When price wicks above a previous swing high, the indicator identifies it as a bearish liquidity grab, signaling a potential downward movement is developing. Similarly, when price wicks below a previous swing low, it is marked as a bullish liquidity grab, indicating a possible upward move is in progress. If you decrease the pivot length and wick body ratio in the settings, the indicator identifies more liquidity grabs because it becomes more sensitive to market movements. This means it will catch smaller wicks and more price movements that could be signs of liquidity being taken by institutional players. Now let me show you how this complete trading strategy works on actual charts, with the indicator helping us identify these setups automatically. On the higher time frame, the first step is to identify the market direction using the structural analysis we discussed. In this case, the indicator labels show that price keeps making higher highs and higher lows, breaking the previous market structure consistently. This shows a clear uptrend, and we remain bullish until we get a definitive change of character. After finding the direction, the next step is to locate the fair value gap areas that align with our bias. On the higher time frame, these gaps are more powerful and can act as strong support or resistance levels that smart money respects. The indicator will mark these fair value gaps for us automatically, and we wait patiently for price to pull back into one of them. When price enters the gap zone, switch immediately to the lower time frame to look for your entry confirmation. On the lower time frame, you want to see signs of a possible reversal that validates your higher time frame analysis. One strong signal is a bullish liquidity grab, and the indicator marks it for us automatically with clear visual signals. Finally, it's time to open the trade with confidence. You can place your stop loss below the low of the liquidity grab, and your target can be the next important level in front of price on the higher time frame. In the bearish case, start on the higher time frame by confirming a downtrend with lower lows and lower highs clearly marked by the indicator. Then identify the fair value gaps as possible supply zones where selling pressure may emerge. When price pulls back into one of those gaps, switch to the lower time frame and look for a bearish liquidity grab above a recent high. Enter the trade after receiving proper confirmation from the lower time frame structure. Place your stop loss above the liquidity grab and aim for the next key level below based on your higher time frame analysis. The liquidity grab feature alone is actually available for free on Flux Charts. However, if you want to unlock the full potential with all the advanced features, including volumetric order blocks, enhanced fair value gaps, and comprehensive market structure analysis, I negotiated the best discount ever for our community to have the complete price action toolkit with 20% off through the link in the description using this code. I do earn a commission when you use my link, which helps me continue creating free educational content like this video. But here's the thing, this indicator is genuinely valuable and something I would recommend even without any sponsorship. Thanks for watching and see you guys next time.